We are thrilled to have with us today Nadeem Meghji, who is head of the Americas for Blackstone and has been there for 16 years now. And for those of you who've done some take-private REIT deals, you've probably done them with Nadeem. So he's a favorite partner and counterparty to many people in this room. There have been a bunch of questions that have come up today about how private equity is going to deal with the higher interest rates, with inflation, et cetera. We're going to see if we can get Nadeem to answer all of those questions today. So Nadeem, let's start with an announcement that Blackstone just made. Small little fund you guys just raised?
Yes, indeed. First of all, thanks for having me. It's an honor to have 25 minutes exactly with this esteemed group to talk a little bit about our business and the market. We're obviously very pleased to have recently announced the $30 billion fundraise for our 10th Global Opportunistic Fund in an environment that's obviously been more challenging broadly in the capital markets, in the economy increasingly. And I think our ability to raise this kind of capital is really a function of having performed over so many decades for our investors. And we have this substantial dry powder at an opportune moment, we think, in the cycle. A moment where there's obviously a dislocation, there's in many respects quite a bit of fear and negativity around real estate, and we think that plays to our strengths. We've done some of our best investing in moments like this where there is volatility. So we think this is going to be a really interesting vintage, and we hope that we can leverage our scale capital to do some pretty unique things, which has always been one of our advantages. We also intend to rely more than ever on the data that emanates from our portfolio as the biggest owner of real estate, because in a world that's changing as fast as it is, it's all about having that insight, that sense of nuance, understanding how the trends are changing, and that's something we're relying on very heavily as we try to navigate this environment.
So these are tricky times. There's been a lot of discussion today about the various cross-currents, headwinds, et cetera. You've gone through a prior financial crisis, the Great Financial Crisis. How do you compare? How is this different? How is this the same? How are you going to play the same or differently in this environment?
Yeah, I mean, one thing I would just highlight in terms of framing where we are in the cycle, and frankly framing the cycle in general, is to compare it to the last crisis, the global financial crisis. That was a time when there was materially higher levels of leverage. Residential real estate, the $11 trillion residential mortgage market was over-leveraged. Commercial real estate was over-leveraged. The banks were over-leveraged. I mean, we sold Extended Stay America for $7 billion in 2007. Our buyer used $50 million of equity, and the rest of it was debt and bridge equity. And supply was higher. There was more building. This cycle, what we see is a lot less building, and frankly, new supply is down not only from the prior cycle, but in the last 6 months. We've seen a 30 to 40% decline in starts, both in housing and in industrial, and there's less leverage today. So we bought that same company, Extended Stay America, twice after selling it, and the last time was in 2021. We paid the same price effectively that we sold it for in 2007, but instead of using $50 million of equity, we used $2 billion of equity. Less leverage in the system. We think that sets up for a much healthier backdrop.
So you describe yourselves as thematic investors. What does that mean, particularly in this environment?
Yeah, look, our approach for the last several years has been thematic, and that's the right word to describe it, because what we're seeing in commercial real estate is that historically all asset classes in real estate would move cyclically together. You'd have an economic expansion, the rents would go up, the developers would start building, the lenders would start lending, you'd have over leverage, the economy would slow, rates would go up, and then the thing would all go down at the same time, and then you'd start again. What we sort of began to recognize now around 10 years ago or so was that sectors were starting to experienced really differentiated fundamentals, bifurcated fundamentals. And what we began to realize is that we needed to understand technology demographics and the impact on hard assets. And we needed to pay attention to how people now live, work, and play, and how that has evolved. And that really led us to concentrate our investing in a small handful of sectors. And so if you look at our business today, in 2007, we were basically half office and half hotels. Today, 80% of our business is in warehouses, rental housing, data centers, life science office, and in hotels. Today, traditional office in the US, which was more than half our business, is now 2% of our global business. We haven't bought a regional mall since 2010. In fact, the first deal I did at Blackstone was to buy a regional mall during the financial crisis, and we thought we were getting a great deal. We paid a 10% cap rate for an asset class that had previously traded at 6.5% or 6% yields. And we made a little bit of money, but not much, and it was really painful. And so what we try to do is learn from the things that aren't going so well as the things that are, and constantly change. The other thing I would say, when you think about this cycle, there's so much negativity out there when it comes to CRE, and you read a lot about that, in the press, and I think the SVB thing has exacerbated that dynamic. But what we see on the ground is that fundamentals in our core sectors, warehouses, for instance, 3% vacancy, data centers, 3% vacancy, rental housing, 5% vacancy, NOI growth, same-store cash flow growth in the first quarter of this year in BREIT, which is our large non-traded REIT, was positive 9% year over year. So what's so remarkable about this cycle is that at this very moment, fundamentals in many of our core sectors remain the strongest we've ever seen. And again, our job as investors, I think everyone's job here, is to be able to understand the difference between the winners and the losers, and not to paint real estate with a broad brush.
So do you see the themes for the next year or two being basically the same as what you've been doing until now? Do you expand? Do you think about how to buy whatever ChatGPT is going to value?
Yeah, exactly. I'm just going to ask ChatGPT what we should buy. So we have a significant amount of dry powder, and we're asking ourselves, where are we going to deploy this capital? And what we conclude very quickly is that the sectors we have conviction in long term remain largely the same. Mm-hmm. And it's because we actually focus on places where we see these structural supply-demand imbalances, where we see secular growth long term. And so what changes in moments like this, when there's volatility, higher rates, more negative sentiment, public companies have traded off, debt is less available, people may need to raise capital for their own reasons, some people might be over-leveraged here and there. The world changes, but sentiment is negative. What that means is it enables us to express a view on the same sectors we had been investing in leading up to this point, but to do so in more opportunistic situations, and to do so at a moment where there's less competition. So I wouldn't say that this moment represents sort of a fundamental shift in the areas where we have conviction or where we're going to invest. It's more about how we invest. And by the way, I'm sure we'll get to talk about that, but in a moment where the cost of capital has gone up for everybody, especially for public companies, there might be more of that as well in terms of transactions with publics.
So let's drill down a bit on logistics. You're obviously one of the biggest owners of logistics real estate, but it's crowded. Everybody, maybe you guys were early, but everybody's figured out this is an attractive asset class, and yet we're reading that Amazon is scaling back. So how do you deal with possibly decreasing demand from tenants and also increasing competition for assets?
It's a good question. And it's a good question because it has been one of the most successful sectors for us, and it's our biggest sector at 40% of our global business. Today, we have a portfolio that's almost $200 billion in value globally, and it's just over 1 billion square feet. And the whole idea around why we got involved in the sector was, again, understanding and thinking about the impact of shifts in technology the tailwind that e-commerce represented. And so we started buying warehouses, but as the cycle progressed, we started moving more and more infill. Places that benefited from what we saw as historically strong demand growth driven by e-commerce, now nearshoring and onshoring of manufacturing. As retailers try to get closer to the last mile, you have continued demand growth, but also places where it's hard to build. So we weren't focused on 2 hours south of Dallas or in McDonough, Georgia, where it's really easy to build million-square-foot warehouses. We went for the less shiny, more infill, population-dense locations. And that's turned out to be a really good bet. Today, to answer your question, what we're seeing on the ground is 3% vacancy in the US. In the first quarter, we had double-digit rent growth. Our leasing spreads, new leases versus expiring leases on 500 million square feet of warehouses in the month of March was positive 50%. You saw Prologis just come out with their earnings yesterday, 11%, I believe, first quarter same-store NOI growth. I think that's the highest they've ever produced. That's not consistent with the end of the real estate cycle in our view. As it relates to both the sector being overcrowded and then Amazon, I'll hit both of those. So far this year, despite, again, all of the headlines and sentiment, we've acquired or committed to acquire over $4 billion of warehouses globally. And we've done it in a way that maybe doesn't make the headlines because it's not one large transaction, it's a bunch of small and medium-sized transactions. And what we found is that we're able to look past the in-place cap rate, the rent that tenants are paying today, and we're really much more focused on the market rent and the market cap rate. We try to find things where we can capture that growth in the near term at a moment where most people just look at the in-place yield, they look at interest rates, and they say that math doesn't compute. So we're not looking at it the way that most are, which is, I think, why we've been so active in the space. As it relates to Amazon, the only thing I would say there is Amazon, we've been hearing, is pulling back for the last year and a half, and yet rent is at a record high and vacancy is at a record low. I think, one, that's because Amazon's still growing at a rapid clip, even if it's slower than it was. The second is that there's so many other retailers who are playing catch up, right? Amazon's always leading the pack in terms of shortening delivery times, but everyone else is chasing fast. Target recently announced that they're expanding their last mile fulfillment. Sam's Club did the same. So I think this is much more broad-based than Amazon. I think this cycle in industrial still has a lot of room to run, and we still strongly believe if you're in infill locations that you can make a lot of money investing in the asset class.
How about data centers? You've made a big push there. Is that likely to continue?
Yeah, so I'll be more brief on data centers, but what I would say is, this explosion in AI, in the cloud, in content creation and streaming, all of this drives demand for data centers. And what we're seeing is almost like an arms race amongst the large tech companies to integrate now AI into their core applications, and that requires data center space. And what we see is data center vacancy as a result has fallen to 3%. In the US, rents are up 15% year over year, and the amount of total data center leasing in 22 was triple the average for the prior 5 years. We bought a company in 2021, QTS Realty. It was a privatization, around a $9 billion transaction. And through development, in most cases for these large companies, with build-to-suit developments, we've doubled the size of the company. And the reason why we're able to do that and why it's such an interesting economic opportunity, commercial opportunity, is because you have this explosive demand growth once in a generation, truly, more than we've seen in anything, anywhere in our business ever. But you also have high barriers to entry. You would think it's not so hard to build a data center. It looks like a warehouse, but actually these can be billion-dollar-plus developments. They require a lot of capital. They require a land bank. You got to have access to power, which is actually not that easy to organize. You need the equipment, and the supply chain backlog has actually made that more difficult. You need to have trust with the major hyperscale tenants. All of that has to come together, and as a result, we see really high development margins. And I think this is going to be an asset class that has not been written about very much, that likely will be written about more going forward. And it's a sector that I think anyone who's in real estate, and I understand it's a bit of a crossover between infrastructure and real estate, but anyone in real estate who's trying to find sort of the winners should probably be spending more time on this asset class.
And your thesis in part is, there's been a lot of talk about AI and ChatGPT and all of that as usual. AI is going to increase data center demand?
Absolutely. So look, our whole worldview around investing, why did we buy Biomed Realty in 2015? Because we saw accelerating growth in R&D spending in biotech. We saw that there were significant advancements in the understanding that we have of biology. We said, what asset class in real estate will benefit from that technological trend? It was life science office buildings. We said in 2020 that there was this explosive growth in content creation. What asset class is going to benefit from that? Studios. So we bought sound stages in Hollywood with a public company, Hudson Pacific. We say to ourselves, with artificial intelligence, the cloud, et cetera, what asset class is going to benefit from that in real estate? Again, it's translating what's happening in the world in terms of technology and demographics, and then saying, how's that going to impact hard assets? And let's go invest in the hard assets that we know are going to win. And frankly, price matters, but what matters even more than that is the secular tailwind.
Okay, great. So let's talk about buying REITs. You guys have bought, I think it's 50 REITs over the last 15 years or so, but you seem to be slowing down. You haven't done that much, call it in the last year. You talk about buying $4 billion of industrial, but with your dry powder, that's not going to really move the needle. So how are you thinking about buying REITs at this point? What's holding you back? Is it the debt, the leverage issues, the interest rates? Why haven't you bought 10 in the last year?
You sound like my boss now. I'm trying. So it's a good question. Okay, so yes, we've always been active buying public companies. We do find that in moments of dislocation, as I was saying earlier, you do have this disconnect between public and private values, and often that disconnect doesn't make sense. And we see, we see that today in a number of asset classes. So of course, we're engaging and thinking about which situations might be actionable. And when we do public company transactions, we do them on a friendly basis. We don't do hostile takeovers, and we have a reputation for performing. So it is something that we will continue to do very likely in this new fund. What it takes for a transaction to get done is it takes a board that wants to transact. And I think in moments of volatility, if a company's stock price is traded off a little bit, most companies are not immediately sort of 3 months later saying, okay, we're ready to be sold. You also need a financing market that needs to function in an orderly way at scale. And I think the ingredients for all of that are starting to sort of emerge. And I think that you will see us pretty active, but it does take time. And we saw the same thing coming out of the global financial crisis, where that situation was much worse and very different, but it took time for very large-scale transaction activity to happen. I do think in that context, having the large-scale capital will enable us to act on large situations when others might not be able to. And in a world where there's less debt financing and it's more difficult to obtain debt financing and leverage levels are lower, I think it'll favor groups like us who can write a larger check, who can over-equitize transactions, who can still find a way to get it done, and then maybe we can do a refinancing later and increase leverage later.
So there's been a lot of talk about valuation today, public company valuation versus private, whether NAV is relevant, whether appraisers are all driving dangerously, as somebody said. How do you guys think about valuations? When you look at a public company now and you're interested in buying it, do you have an NAV on it, or how do you do it?
Yeah, we tend to do NAVs ground up, and we think we have a decent ability to do so because we're constantly transacting across asset classes. So we think we have a pretty good sense of private market values across asset classes. Look, in moments like this, what you find is that the public markets are so sentiment driven that the price on the screen is just not reflective of the underlying value of the real estate. And by the way, it goes both ways. You know, in some moments, like at the end of 21, the REITs were arguably trading at a premium to the value of the real estate. Today, clearly they're trading at a discount. We're selling apartments, selectively in places like the Sun Belt at cap rates today that are sub 5%. We have 30 bidders. You know, first of all, we have like 200 confidentiality agreements signed, which is higher than we've ever seen. We have 30 bidders. We have several bidders in the best and final. And the pricing is, relatively attractive for a seller. And those buyers have dedicated equity capital that in many cases they had raised already. They're able to borrow from the agencies. And when I compare those yields to where the multifamily REITs are trading, which is north of a 6% cap rate, there's an obvious disconnect there. And the same can be said to different degrees, to varying degrees across asset classes. So I think the other thing about this that's relevant is that people often look at the public company share prices as if that is the arbiter of the value of real estate in America, when in fact the listed REITs represent around 8% of real estate in the United States. 92% of it is privately held, is traded privately, and so often the way in which one can understand intrinsic value is not by looking at the listed share price, but instead looking at the private market. So
you don't buy the argument that REITs are simply ahead of the private markets, they're just a leading indicator because they're liquid and the private markets are not. That's not.
I buy it to an extent. I think that the market is for sure more sophisticated than it was in prior cycles, and increasingly has a better understanding of the sectors that are doing well versus the sectors that might be more challenged. But I also think that a lot of the public companies are held by passive funds that sell often indiscriminately at a moment when maybe all of real estate's being painted with a broad brush. So I think what happens is there's some sense of rationality in terms of maybe how the sectors are priced relative to each other, but all sectors, I think, tend to be too heavily discounted in moments like this.
So let's talk about the debt markets a little bit, the CMBS markets, the typical LTVs in deals. How are you thinking about all of that?
Yeah, I mean, leverage levels heading into this before rates went up were lower than prior cycles, as I said. We were maybe topping out in our opportunistic funds at 70% leverage, plus or minus. And then as we got into the back part of last year, what was happening was less leverage levels changing, although there was a little bit of a change in dynamic because lenders were more focused on in-place cash flow and on debt yield, so that maybe brought leverage levels down a little bit. The bigger issue was just quantum of debt availability. And when we got into the beginning of this year, you saw the debt market starting to loosen up a little bit. Still not back to where it was in early 22, but it was loosening up. And then SVB happened. I think that as a result, credit conditions are more difficult today, certainly, than they were a year ago. That's not to say you can't get a transaction financed, because there's insurance capital that wants more exposure to real estate. You have the agencies still lending to rental housing and all forms of housing. You have bank balance sheets, which despite all of these headlines, the big banks are still open for business and they'll still lend to sort of their top relationships, their top borrowers. So you can still get things done, but it's harder. And I think, again, the fact that it's harder, the fact that leverage levels may be a little bit lower, just plays to the strengths of folks like us who have the ability to write bigger equity checks and still find a way to get transactions done. But it's certainly not the same environment that it was.
So it looks like we're starting to run over, but I did want to touch on this little REIT you guys have, B-REIT.
I think we're out of time, actually.
What's the latest? Anything you want to tell us?
I just say a couple things on that. So, we started BREIT at the beginning of 2017 with the idea of really delivering institutional quality investing to individual investors. And we did so with a format that was different. We said, the NTR space was one that was more focused on fees than it was on delivering performance. And we created a new fee structure that was similar to our institutional structure. We, since the beginning of 17, have really delivered for our investors, producing a 12% net compounded annual return, which is 3 times higher than the listed REITs. And it's because we created what we like to call the 70, 80, 90 portfolio. 70% Sunbelt, where the country's moving, 80% rental housing and warehouses, sectors that we think have really strong tailwinds. 90% of our debt is fixed for 6.5 years at very below market rates. And that business produced 13% cash flow growth last year, 9% cash flow growth in the first quarter. And as we look forward, we think it's well positioned because we're in a world now where supply was already short in our sectors and is now declining further. And it's probably going to decline even more with what's happening with the regional banks. Interest rates, as inflation has come down, have begun to come in moderately, which is a tailwind, we think, for real estate values over time. Our rent roll is below market, which gives us organic cash flow growth. So a lot of news has been about our capital flows and about increased repurchases. Our focus from day one has been on performance, not on flows. Our view is that if we continue to deliver performance, then flows will follow, and that really remains our focus today.
That's great. So 70, 80, 90, and 13%. Very catchy.
There you go.
Well, please join me in thanking Nadeem. That was a fascinating conversation.
Thank you.
Perfect.
Appreciate it.
That was great.